2024 has been strong for the markets. S&P 500, as you can see, up almost 30% in the past 12 months. But our guest warns that we could be on the precipice of an economic slowdown, and that means some company valuations are too high to be supported. Let's get more from Mike Vinokur, portfolio manager at MV Wealth Partners at IA Private Wealth. Great to see you. Thanks for coming on the show, Mike.
Oh, pleasure to be here, Andy.
So when you talk about the risk of an economic slowdown, you mean in the United States?
In the United States and in Canada and broader, we're seeing slowdowns in the economic indicators, even across Europe, and China's trying to stimulate, but I think the jury's still out in that part of the world in terms of how their stimulation is going to bode for the actual economy on the ground.
So what groups are you wary about? Say, just in the U.S. market, so much global money has gone in there this year. What groups in particular do you think may be overpriced?
Well, I think there's some standouts. Tesla maybe is one. Some of the semiconductor stocks, some of the Mag 7, like Apple, for example. These are great companies if you think about it from a technology perspective or from a product perspective. But we think that the valuation there has just gone a little bit over the skis. And we're concerned that the market returns have pulled forward a lot of the good news that may be coming over the next 3 to 5 years.
What about Canada, Mike? I know it's a very broad question, but if you were choosing to put money into either Canada or the US right now, would you have a preference, a strong preference?
No, we don't look at it on a geographic basis. We
Right.
typically look at it on a company-specific basis. There are many Canadian companies that operate globally. So we look at the micro picture when it comes to fundamental investing, and we are seeing some great bargains both in Canada and the US, which have nothing to do specifically with technology stocks. But these companies are going to be able to use technology like AI and whatever other amazing software or automation technologies that come out of the tech sector in their own businesses in order to increase productivity, increase profit margins, and therefore, increase valuations.
That's an interesting theme. Can we start off, though, with a couple of ideas? We'll get back to it, but can we start off with a couple of ideas you have for us in energy? You think Suncor and Cenovus look like good bets right now?
Absolutely. The narrative as of late in our view has been that, oil and gas is going to go down because drill, baby, drill, and because, we're awash in oil and because China's still slowing. Well, we think that people forget about something called the decline rate. And to stop production from declining, oil and gas companies around the world have to invest a very big sum of money. And that investment over the last 5 to 8 years has really gone down from where it was in the mid 2010s, let's say. And we don't see the type of investment required in order to maintain and grow production. Mm-hmm. So unless somebody's going to come and say to us that, the demand for oil and gas is going to come down dramatically, we think that the price of oil is probably going to find a bottom in and around here, and then potentially, depending on what happens on the economic front and the geopolitical front, has a lot of upside. Having said all of that, Suncor and Cenovus are phenomenal companies, given the fact that they have great operations, they're in politically stable jurisdictions, they're integrated, and their balance sheets are so pristine now that even at these prices of oil and gas, they can afford to buy back a very large amount of their stock, giving some support.
Your next idea is Rogers Communications. Is this one of the companies that will be able to capitalize profitably on AI, do you think?
I think so. When you call into their call line now, most companies anyway, you have the automated bot saying, "How can I help you? Can I do this? Can I do that?" Without a human having to come and interact. Well, as that technology progresses, I would like to think that the productivity enhancement and the cost reduction of actually interacting with clients from a human is going to come down per interaction, and that just is going to fall to the bottom line.
As you know, it's been a dreadful year for the telecom stocks, especially our parent company, BCE. The shares have slid. Rogers out of favour as well. But, debt is one of the concerns after their big takeover of Shaw. But you think the stock is too cheap now, Rogers?
Yeah, it's trading at approximately 9 times free cash flow. So unless somebody's going to tell us that all of a sudden that free cash flow is going to meaningfully decelerate or reduce, we think that given the new interest rate environment, especially in Canada, it's an oligopoly. And so this kind of company should be trading at more like 12 to 14 times free cash flow, not 9. Mm-hmm. So we think that there's quite a bit of upside from here. But in the meantime, there's nothing wrong with the operations. We collect a very nice dividend. I believe it's well over 4% now. And we see avenues for growth based on the bank, based on the acquisition of MLSC, et cetera.
Right. That's interesting. Yeah, it's a contrarian call, obviously. Yeah, the dividend's about 4.5%. Mike, we've only about 30 seconds. Uber, you think, looks set to do well in 2025?
Yeah, Uber is basically the number one in their field in our view, and they are just such an innovator with their network of subscribers across the world. Every time they come out with a new idea, it's awe. We're in awe, and we think that all of these customers that they've got, they're going to be able to collect more dollars, which are going to fall right to the bottom line.
Thank you very much, Mike.
Pleasure.
Mike Vinokur has been our guest portfolio manager at MV Wealth Partners with the IA.